All right, so the market ended the week on kind of a flat note. A great Tuesday, a big opening gap on Tuesday, and then we've kind of held that. And on the large cap stock indexes, we didn't hold that gap on the Russell 2000. The Russell 2000 actually finished with kind of a bearish pattern to finish the week, below the 200-day moving average, filling in the gap below the low yesterday. Whereas the S&P was kind of the opposite. So we're going to talk about why that's the case. Why are they so opposing right now instead of kind of moving in lockstep with each other, which is kind of typical. And what's really driving that price action today, going into Tuesday, finishing Tuesday, and then since when we didn't really have very much of a move at all. Like how much risk on, how much risk off there is. We're going to break all that down. What's driving it, what that means going into next week, right? Especially early part of next week. I think there could be a significant move there that could spell what we might see. And I'm going to show you that, what I'm looking for in today's video. And we're also going to take a look for our trade idea, the stock that's had its own little bullish move and now it's kind of consolidating. So we'll talk about how to trade a stock that's got a really good bullish breakout, getting back above the 200-day moving average, looking great, but it's kind of still overbought. So how do I trade it so I don't feel like I'm chasing it? So let's go ahead and get started. Today is Friday, December the 10th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator like we always do. Nice little rally to close the day today, getting above the prior 3 days highs. So a good sign from an S&P 500 standpoint, at least. Intermediate posture still strongly bullish, rising long-term market sentiment again. The near-term line staying at least in bullish territory. Momentum line bouncing back from bearish lows on yesterday. Extreme bearish lows, so getting below the 5th percentile. We had closed below the low of the higher day of the high day, so to speak, and then bouncing back up to neutral territory, which is fine. It's the near-term line itself has gotten to really bullish highs, so you don't need the momentum line to also confirm this new bullish run. But dark green shading in the green line, and you're in bullish territory now on the market on the intermediate line, and barring something drastic early next week, you're going to have a pretty decent. You're most likely it's going to get back up into above 80. So a good level for the S&P to be in right now. If you look at the Dow Jones Industrial Average, you can see a similar chart, not quite up above 70, but good bullish, good close back above the 23% retracement for the Dow, which is a good sign too. Almost 1% above the moving average, and the intermediate line getting back almost back above its market sentiment line. Nasdaq 100 kind of not quite as bullish. We didn't quite close up above these highs here. The intermediate line still actually in neutral territory and below its market sentiment. The near-term line actually did drop. So we actually had more of a bearish drop yesterday. So the near-term line did drop in the bearish territory here, but would be a higher low point from the last near-term low. And then finally, the Russell 2000, as you can see, not only did it not close above the prior 3 days highs, but it actually closed below yesterday's low point, which is unique. And as a result, its intermediate posture is still strongly bearish. It's still bearish. It's got light green shading, but you're still in bearish territory. And market sentiment's falling. It's now no longer in bullish territory, and the near-term line fell to oversold levels after one day after getting even more extreme short-term sentiment on that momentum line. So, but the difference here is, this again, it would be a higher near-term low point. I mean, it was a lower near-term high. We haven't had a near-term high since this one. So this was one big long near-term drop, which is pretty rare to have a extended near-term drop. Usually, one of these would turn into a near-term peak in bullish territory, but we didn't get that. One continuous near-term drop. Excuse me. So this would be a lower high, but if this is all the near-term low we get, this would also be a higher near-term low point. So this is something to keep an eye on there. If you take a look at the S&P 500 on the weekly chart, so let me pull that up here. There we are. So after a week of getting the near-term line in the oversold levels, it is back out now. So again, that's kind of when you get your intermediate declines, is when the near-term line on the weekly chart drops into the lower reversal zone, as you can see in all these other instances. Sure, on the COVID low point, we barely got into the reversal zone. And you can see some of these others. That was actually an intermediate decline where it didn't quite get there, but at least got into bearish territory. And you can see a couple of, the fourth quarter 2018 and then the first quarter of 2018. So a couple there in 2019, and then as I mentioned before, a few kind of minor declines, that weren't quite intermediate declines on the S&P, but you did dip below 40. So that's kind of what we got now. The momentum line did jump back into bullish territory up to the 87th percentile. So in the near-term line's back out of the reversal zone. So just like that, and you can see the weekly candle up there getting back up, back above last week's high point. Very strong rally on the S&P. So the Russell, on the other hand, is actually still below its 30-week moving average, right? The intermediate line, the near-term line, has stayed down in lower reversal zone and bearish territory. You notice that hasn't happened since COVID, and then fourth quarter 2018. And now the intermediate line's in the lower half of the chart, which doesn't happen very often either. It did briefly over here in 2017, and then we had that big dramatic run. But needless to say, it's a lot more bearish, not only on the daily chart market forecast, but also on the weekly market forecast, which again makes you wonder about the strength, the overall bullish strength that we may have broadly if one of the major indexes here is doing something dramatically opposite, pretty much 180 degrees opposite there. Let's take a look at the weekly chart on the Heikin-Ashi candles. So you got your green arrow, you got your positive differential this week, and you got a rising PPO. So you're back. I mean, that's a bullish pattern on this chart. That's a bullish pattern. On the Russell 2000, not the case. Still a negative differential, still falling PPO, and not getting. In fact, you didn't even get a upper shadow at all this week. Now, granted, next week we're going to close at 22, or open, excuse me, at the midpoint of this range. So that means next week we're going to open right around, right around 22.35 or so, and we're trading at 22.11 right now. So, and the range, you can see the range this week. If I were to look at the regular range, the range this week was 122 points. So, to get an upper shadow next week is not going to be that big of a deal at all. Easily a normal daily range. So let's take a look at the three green arrows charts, and you can see, hey, green shading now on the Qs, green shading on the S&P, green shading on the Dow, and it's continuing. It's not just a one-day thing, like the one-day light pink shading that can lead to a bounce. A one-day light green shading can lead to a drop. So the only one we're not getting a green shading on is the Russell, and you're nowhere near the moving average in order to get that. So bullish charts, except for the one down here over on the right. Let's look at the two-line version and see how. Let's look at IWM first. You can see not only did we close below yesterday's low point, but yesterday and today we are down below the 8-day moving average. We are down below the point of control, and now the 8 and now the 17-day have crossed below the 200-day. So we've been down below the 200 far enough and long enough that you've got those other moving averages that are falling, and of course getting the 30-day to cross below the 50 would also be a bearish kind of crossover. It would be kind of like a mini death cross. And then eventually you would expect the 50 to cross the 200. So, again, you can see that we're really kind of flattening out on this 200-day moving average and not getting a lot of movement anymore to the upside after this kind of fake out there. And then again, you can see that what we have going to the downside. SPY, on the other hand, looks really bullish, right? The The 30-day is above the 50. They're both above the 200. So from a long-term perspective, golden cross environment for both those levels. And now you're not only are you above the 17-day moving average again, but you're above the 8, and now the 8's above the 17, and now the 8's above the 30. The 17's about to cross above the 30. You got some good bullish crosses going on here up above the this is up above the 2-year value area, and looking like it's going to be trying to get above the 1-year value area here and get going there to the upside. So, and that's what actually is going on right now on the Qs. So the Qs is above its 1-year volume area. Most of its volume back in here in February and March. Remember, we did have this pullback here, so that produced a lot of volume down there. And you had this pullback here, and you had another amount of volume here. And now we've bounced off of that to new highs, and trying to figure out whether we'll break through this volume or not too. We are above the 17-day moving average. The MACD now is crossing above its moving average, so you're in bullish divergence mode on the Qs. And as I already showed you, IWM and how bearish that is. The diamonds looks very similar to the S&P. Sometimes it looks very similar to the over here the S&P tested the 50-day moving average and bounced. The Dow actually tested the 200-day moving average and actually got below its 1-year point of control before bouncing back up, and now getting back above the 50, the 8, 17, and the 50 and the 30, and then everything starting to move back up higher again towards the top of this value area. Let's take a look at some of the other oscillators. Here's the DMI for SPY, and pretty neutral. They're both down really low at 20, so I wouldn't put a lot of stock into any kind of trending move yet. IWM, after dropping below 25 on the negative, is now popped back out above 25, and you're still below 20 on the positive. So you actually still on this bearish move according to the directional trend index. If you look at the RSI and the CCI, we are in bullish, that half of the chart, but not necessarily in strong bullish levels, which would be above 60 and above 100. If you look at the Russell, you can see that we're still in bearish levels, like we're still in the lower half of the chart. We've made a run up to it, but hit resistance and roll back over that kind of level we were watching for previously. Trend strength indicators, you are very noisy on the S&P, so no trend yet. They're not even close to one, and the Russell is still in an intermediate bearish trend. Not quite mature yet because it's not below -5, it's not above 80, but pretty close. All right, so you're still in a pretty strong bearish trend, an intermediate trend, not necessarily a long-term mature trend, but at least you're in an intermediate trend right now, a pretty good one that hasn't been shaken out despite this 3-day rally that we had earlier this week. All right, let's take a look at the Bollinger Bands, and that's the one I was showing you previously. For SPY, we are in the upper quartile, so good bullish. Everything's rising. All 3 lines are rising there. For IWM, we are not in the upper quartile. We're actually still, now we are in the midpoint of the chart, this is the lower half of the midpoint, but at least we're not in the bearish quartile yet. And like I said, we're back below the point of control. It's a very narrow value area. So getting below 215 will be a really significant level because it would be below the value area, and of course breaking below 210 would be getting us below this 23% retracement level that we have not been below. We've made multiple attempts at it but never really gotten and stayed below that level. And the bandwidth looks like it's really strong bandwidth. It's starting to break down a little bit. So we'll see if we continue to center around that volume node like we've had for most of 2021, or are we going to break down after a fake out? Are we going to instead break down in the wrong direction? All right, if you take a look at today's intraday chart, you can see that we held the gap from Tuesday. We filled in this morning's gap, but then a good finish up above yesterday's close. I mean, that's about as good of a finish as you can get on SPY. On IWM, it's the opposite. We actually did not only did we not close, not only did we not get higher highs, higher lows, and then not close above yesterday's high, we got lower highs and lower lows, and we actually closed below yesterday's low, and we filled in Tuesday's gap. So it's a totally 2 different markets that we're in here. You got the S&P 500, which even the Qs wasn't that bullish. All right, you look at the Qs, we didn't get a higher high. We closed at the highs of the day, but we didn't get a higher high. And we did hold the gap. It was under attack earlier today, but we at least held the gap. Um, but the S&P was really bullish, and just nothing else really followed suit. Diamonds did. They did close above higher highs and higher lows and close above that high point, and we easily held that gap again from Tuesday after threatening it yesterday. And you can see, very little volume below that gap, so that's why it's such a danger if we fill it in, as to how bearish that can be. And keep in mind too that the diamonds have filled in that gap from last Friday, the Thanksgiving gap, the post-Thanksgiving gap. SPY has as well, obviously, but IWM has not. Right? It held yesterday or Wednesday, the Thanksgiving. Post-Thanksgiving gap. It's held that and actually bounced off of it for resistance. So again, kind of really two different markets that are going on here. And then you look at the volatility index. Let's look at the volume and trading range, which is kind of interesting too. When you look at today's volume, it was 77, so we did get up above, even with a very slow start to most of the day. Even with the inflation data, we had a very slow start in the volume. It picked up at the very end with a bullish close. We had 77 million shares trading hands. Today's range was ultimately got to 4 points, over 4 points, which is a good sign, because when you put those numbers in context, we were only at 2 points, or under 3 today. But getting up to 4.4 is actually better. And then getting to 72 million on the volume was relatively better too, even if it's below the average. It's a good sign that things are kind of returning to normal. But keep in mind that we still haven't hit that 2% mark. We didn't hit it on this intermediate decline either. So that's usually when intermediate declines end. Now, like I said, there are a lot of signs that shows that we didn't even have one on the S&P. But if you look at IWM, we did have one, and not only did we get to 2%, but we got well up above that. We got pretty much near 2.5% ATR. So lot more volatile on the Russell compared to its average than what we're seeing with the S&P compared to its average. Finally, let's look at the volatility index, and you can see the big drop in volatility at the very end of the day today. So, we did drop below 20, but we're still kind of relatively high comparatively. We're still up in the high teens, closer to 20 than we are 15. But despite that, volatility finished the day at extreme low points. Very, very low. So it's interesting to see how low it's dropped. And the VXV didn't drop very much. That's why, with this dropping, VXV is still up above. It's actually quite a bit up above at 18.69. If you look at the VIX 3 months, it's at 23.2, so it's still pretty darn high, relatively speaking. And just barely recently, we were at 31 to 33, 34 on the VIX 3M. But if you look at the regular VIX, we were also the 31 to 34, so that's why we were at 100% there, because both those lines. But this has dropped a lot more than what VXV has dropped. It's still actually has held up pretty nicely up in the 23 level, which again, it makes that means the market's not really concerned about things in the short term as much as they are concerned about things more in the intermediate term, more outside of the next 30 days. So kind of, again, tail risk kind of a issue. It's looking for one of those kind of moves that, according to the skew, might make us, might be one of those kind of 2 standard deviation moves there over here. And you can see the skew updated for today is still near 150, if not, not sitting right at 150. 147, and a smidgen below its moving average. And we'll see if it really breaks down hard below its moving average, then that means now there's not as much demand for tail risk. But you can see we're near 150, which means there still is a lot of demand. Not only that, but the moving average is near 150. There's still there's a lot of demand for this tail risk, for hedging tail risk. So to summarize the technical outlook, a good close to the week is a very good close to the week, and it's got some signs that the S&P can continue its bullishness going into next week. The Russell 2000's got other designs though, and so that's a little bit of a concern. And the fact that the market's so bifurcated makes you think that there's not a good trend developing in either direction right now. So we're pretty darn neutral until we get this kind of Dow Jones, this Dow theory type confirmation where these different indexes, one more broad than the other, but both relatively broad in their spaces, are both kind of confirming each other. And right now they're so bifurcated. I mean, it's not even like they're both kind of confirming each other and maybe just one's lagging. No, one is bearish and the other is bullish, and they're both going in opposite directions, showing opposite signals. And that tug of war might just keep them both sideways ultimately by the time all is said and done, until, like I said, they confirm each other in either direction. So that's kind of what I expect. I expect we'll get some choppiness, over the next week or two of volatility up and down until they both break out in the same direction from a trending standpoint. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am? Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch if you don't like them. Also, join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us on our blog here, check out some of these things over here on the right. Click on this icon. It takes you to our Market Outlook live page right here. This is on 3:30 at 3:30 Eastern time on Monday, Wednesday, and Fridays. I post a video. It's hosted on this page right here. It's done live, so you can come and watch it. You can chat with other viewers over here on the right at the same time. It's only a quick 10-minute, 15-minute video. We look at all the existing trades that we have on from other Market Outlook videos to see whether we should stay in them. So we manage them, take a look at them, close them if we need to. We also put on today's trade idea already before the Market Outlook video was posted, so that we do that every time I put on that day's trade idea there. You can see all the archives down here at the bottom. If you come over here, you can also get to it if you come over and mouse over Market Outlook and click on Live Trade Review. Come down to the bottom. Here's our upcoming classes for next week. Click on View More. That takes you to our calendar. You can see all of our classes here, all of our recordings from last week, as well as last 3 years worth of recordings. You can also get to it too by just clicking on Trading Rooms and our archives right there. Come down to the bottom, hit that thumbs up, that heart. That takes you to this tab. Hit that like button. Also click this thumbs up icon, takes you to your Facebook page. Click that like button. Again, the more you do that, it helps get our content out to more of our followers, more than just 103 people, because that's how these algorithms work. The more engagements there are, the more they will promote it to everybody who follows our accounts. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching. Alright, now let's take a look at what's driving the price action that finished the week here. And you can see the Qs are just going nuts, just rallying up here. In fact, if you really look at the last week, this whole week, going into starting Monday going into today, really had a big jump in all equities, all risk asset classes, including QQQ in this case. But by the end of the week, emerging markets and small caps kind of lagged behind, but commodities stayed really strong. See, small caps really had a good start to the week, but then really wasn't able to maintain that Tuesday breakout. In fact, ended up filling in the Tuesday gap by the end of the week, and whereas SPY still hasn't, right? So there's the gap all the way up to here, and you can see we did not fill that gap in on the S&P. And look how bearish bonds were. Bonds had a really bad week today, or this week. Let's take a look at its chart here on the market forecast chart. And you can see long-term bonds pretty much getting back down to Again, this is the week that was. We finished right there on a Friday, getting above that 50% retracement, kind of a little bit of a breakout, and then back down. Back down pretty hard, pretty much 4 down days with one little up day Harami pattern in the middle there. The intermediate line has come out of bullish territory with a really bearish short-term sentiment, but you notice we're still up above that moving average there. So really mostly sideways. We're really not getting a trend in either direction right now on TLT. You can see it's been pretty noisy. One little bearish period right there that got a trend, and you obviously got a bullish trend in the summertime going into those expiration dates, June, July, and August expiration. We had a good little rally there, and then it's been pretty noisy since with that one little bearish move after, of course, a really big bearish trend coming out of COVID, right? So, and that was actually about 6 months after COVID, but you had that big bearish move. We're obviously not in a big bearish move anymore, but we're also not in a bullish move either. We're kind of stuck here. We're above the 38% retracement of this big bearish run, but we're not, we're not really like moving anymore. But keep in mind we are above the cloud, and we are just barely below the blue line, so we're not necessarily tanking here either. We are at the point of control, which is still below us. There's still support here. You still have you're still at about the midpoint of the Bollinger Bandwidth, so it's not like we're breaking into the lower, breaking down hard. So it'll be interesting to see if this support at the 38% Fibonacci as well as this point of control holds and bounces as you would expect it would. Gold, you can see, also had a pretty flat week, down compared to equities. You can see it's also stuck around its midpoint too, and stuck without a trend going on. You can see gold is in a noisy pattern itself, still above the cloud but below the blue line, and not really going much of anywhere. If you take a look at the euro, let's take a look at the US dollar, which is pretty much a euro US dollar. You can see the strong bullish trend it is on right now, above 5, above 80. It's a very strong trend, kind of flirting with that 80 level. You can see it's also got a strong bandwidth, at least it's a strong position within the bandwidth in the upper half. Has moderated some as we are up above the value area, forming a little bit of a volume node as we consolidate. You can see we're pretty much in a bullish convergence mode right now on UUP, where the MACD is below its moving average. The MACD histogram peaked, the MACD itself peaked. We're below the moving average. This is bullish convergence, but we're still above the 17-day moving average. So we haven't started a bearish divergence yet with a bearish move to the downside. So and if you take a look at how currencies performed, if I were to go to the currency comparison chart here for the week, so let's go custom down to December, and then we'll go all the way through the week. You can see the dollar and the franc and the yen all were underperformers, and those are your safe havens. So the currency markets are telling us they're pretty much in a risk-on mode, and you can see the Mexican peso, Swedish krona. I mean, that's Mexican peso is a commodity related within the Latin America subset of the emerging markets. You have Swedish krona, which is a commodity currency within developed markets, along with the Australian dollar, the Canadian dollar, the Norwegian krone, and you can see the pound and the euro kind of lagging behind those currencies. There's New Zealand dollar as well, kind of a more related to softer currencies, and then of course your franc and your yen and your dollar, your safe haven areas, and they're all lagging behind. So pretty much a risk off move there. If you take a look at the major sectors or major economies out there and their stocks in their countries, we've had a good, this week was pretty much a snapback. It was a oversold technical bounce. Nothing really trend changing. The only one that's really close to trend changing is the Brazilian market. As you can see, you have dark green shading and a green line. We haven't had the intermediate line above 60 for a long time. You had a really good strong near-term rally here to kind of bust you through and get the dark green shading and the green line up above 90. Now your intermediate line's up there. So it's actually looking pretty good. It's been so bearish, and it's been consolidating here for quite a while, converging. You've had this bearish convergence going on, and then now you can see you've busted through the 50-day moving average. You're still below the value area, so we're not out of the woods, but at least you're into that 50, and there's quite the gap between the 50 and the 200-day moving average to fill in to the upside. So very interesting pattern. You're above the 8, you're above the 17. You're in bullish now. Now the question is this the peak for the MACD histogram, which means the peak for the MACD is coming soon, which means that we may be done with this thrust, the momentum part of the move, and now we're going to be in the convergence part of the move. So, and how long may that last before we get another divergence? And will the next divergence be a bullish one again, and start to fill in that gap, or will it be a bearish one and we'll get back below the 30? Because we are in a death cross environment. Both on a long-term basis with the 50 to 200, but also on this more intermediate-term basis between the 30 and the 50, right? It's pretty strong. Now, granted, the 8-day and the 17-day are above the 30. They're not quite above the 50 yet. That's kind of the next stage when you get the price above the 50 long enough that the 8 and then the 17-day crosses above the 50, and then eventually the 30 crosses above the 50 for your kind of golden cross pattern there. So what's interesting too is Bitcoin. Bitcoin has, we came off the COVID low point with such a strong move. You got above the 200-day moving average over here in April of 2020, and then you pretty much stayed above the 200. Even though you kind of went sideways, you're still at least above the 200-day moving average. You got a golden cross over here. He had some ups and downs, not really a whole lot of movement, right around the $10,000 mark. And then you took off. From there on this intermediate rally, and then you can see that we are actually now in the last 6 months we have broken below the 200-day moving average 3 times. We had been so bullish for so long. Now we're broken below it. We had a death cross briefly, but that didn't last very long. Got back above the 200, and then now you can see obviously you're below the 50. You're below the 200 now. The 8 and 17 have crossed below the 50. The 30-day now is crossing below the 50. So Bitcoin, again, there's not a whole lot of volume here either, and you're at that 38% Fibonacci level at the 200-day moving average. So Bitcoin's really kind of at this point where, again, as a reflection of speculative return demand, right, of really high returns, not a hedge against inflation. It's more a speculative trade, and you can see ARK is another one of those speculative trades, and you can see it has a death cross. It is below the 8-day. It has broken below that 38% Fibonacci level in the 2-year chart here, and you can see now it's breaking or trying to break below the 50% retracement as well as the value area for the 2-year, which means there's just no volume down here. So a very easy move to get to 81 and then down to potentially to 60 if you were to break that. I mean, there's so little volume, and that's the pre-COVID high point there at the $60. Again, a reflection of speculative demand, right? Speculative return demand. We see that those kind of moves are kind of been priced into the market with the skew index. The skew index remains really high. The moving average has gotten really high. This was brought up in my Q&A session today to look at the NASDAQ lows. And what's interesting about the NASDAQ lows on a weekly basis, let me update this. This is a very interesting chart. One of our students was listening to a video and talked about this idea. Like if you look at, you get these spikes. Generally, these spikes in the new 52-week lows on the NASDAQ occur with declines. The COVID decline, the 2018 decline, the 2015-16 decline, and then the bear market right there. You can see when the moving average gets above 100, again, 15-16 decline, fourth quarter 2018 decline, COVID decline, the credit downgrade decline, of course, your bear market right there, and then another bear market back in September 2002. But now look at here, here we are. It's at 107. It's not only above 100, it's above 150. And like I said, getting above 150 has only been COVID, the fourth quarter 2018, and this bear market in 07, at the end of 07, beginning of 08, and then the culmination of the bear market. So getting above 150 for the 20-day average to get that far means that there's a lot of new lows right now. The let's see here, the breadth within the S&P 500 and especially the Nasdaq. Let's go to the let's see. I don't think it has the Nasdaq composite here. Let's just go to the S&P 500. The number of stocks that are above their 50-day moving average, and let me chart that here. Let's go out 2 years. So you can see, updated through Friday, we're back below the mean, and that, when you're below the mean, you're typically in, weak, pullback type mode there. So, we are hardly bullish right now, and I did like this one tweet here. I think I retweeted it. Here's the percent of stocks that are above. This is for the Nasdaq Composite. The percent of stocks that are above their 200-day moving average in red, and the actual Nasdaq Composite in not the Nasdaq 100, but the Composite in white. I mean, that's a drastic difference there. It's one, obviously you're going to be bullish. There's going to be a lot of people moving on, but since pretty much the beginning, early part, March, April of 2021, earlier this year, we've had more and more stocks below 50%, actually below 40%, 35%, 34.5%, whereas the Nasdaq's continue to march higher, the Nasdaq Composite, because of obviously the handful of companies that are really driving the price up, including Apple. If you look at Apple here, Apple is pretty much going parabolic right now, and it's gone parabolic before. Let me show you, going back 5 years. So you went parabolic right there. This was an interesting period in August of 2020, because that was a period where, it's actually right where my cursor is, right here, where we hit the $2 trillion market cap, if I remember correctly. Let me just make sure, because I tweeted that out here. 1 second. Yeah, right here. So 2.5 trillion, and as you know, we hit the 2 trillion mark in August of 2020, and you can see pretty much what happened. So we had gone parabolic there in August of 2020, going into that intermediate decline, and then we just went sideways for months. Like, you don't see it on the rest of that chart here, but after that move, right there is when we hit the 2 trillion mark. So we kept going up, but then you can see going all the way out, for months we were sideways, right? Follow my cursor along. We went all the way to here. We were sideways all the way out to here in May, June, with very minimal gains before we had this last little run here lately. So that was when we hit the 2 trillion mark. The $1 trillion mark we hit right there, and you can see we also kind of went parabolic at that point in August of 2018, and of course you can see what happened in the fourth quarter of 2018 when the whole market went bearish. So a couple of parabolic moves when we hit the 1 trillion and the 2 trillion. Well, guess what's happening now? Here we are, and you can see my cursor. So we were pretty far up above the 200-day moving average there, almost 10%, the 30-day moving average. We were pretty obviously there. We were really far above it, and we're about there again. Where the only times that we've been higher than now above the 30-day moving average is going into that $2 trillion mark, as well as not only did we hit the $2 trillion mark, but we also had the 4-for-1 stock split. So here we go now into the $3 trillion run with a parabolic move, and you can see we are that close. I think that's 182.85, so we're only a few bucks away. We could very well hit that on Monday. Now the question is that it, right? Because the last couple of times, one time it sparked a market sentiment decline in 2018 when we hit the $1 trillion mark. In 2020, it sparked an intermediate decline when we hit the $2 trillion mark after we had gone parabolic there. What are we going to get now? Right? Are we going to get a market sentiment or market sentiment hasn't had a decline since the COVID low point. We're going on, nearly 2 years, more than 1 3/4 years. So are we going to get an intermediate or a market sentiment decline when Apple finally hits that target, right? I don't think Apple's got a price target right now. I think it's got a market cap target that the market is pretty much pushing it up to. And like I said, I mean, if you look at like the directional movement index, you can see it's going parabolic. I mean, look at the daily, look how long it's been above 40. Look at the ADX is starting to rise. It's lagging too, so it's gonna really take off. here with these up as high as they are. Here's the weekly, and you can see it's taken off. Now there was the parabolic run here in let's see, that was in February of 2020, going into COVID, and then there's your August of 2020 when we had when we hit the $2 trillion mark, and this is when we hit the $1 trillion mark. So we had gone parabolic there on the weekly chart, we had gone parabolic there on the weekly chart, and it appears that we're going parabolic here. At the very least, the negative in the index is lower than we were at the 2 trillion as well as at the 1 trillion. So the positive might not be as high, but the negative is much lower. And so, you can see it pretty much looks like we're going parabolic here. Here's the 3 green arrow with the volume. Let's go to Apple and then pull up the volume chart for this, so we can see what that looks like compared to average. And you can see the last 2 weeks where we've really kind of shot. We've had more than 1.5 times the average volume on these weeks, on bullish weeks, not bearish weeks, but on bullish weeks. So, I think Apple is kind of getting to that exhaustion mode. We saw the increase in volume on that parabolic run. You can see how high the MACD got. You can see how high the MACD is getting again. If I were to take off that MACD and throw on the PPO instead, so we can kind of get an idea on a relative basis, because that price changes so much. Look on a relative basis how high that MACD is. So it's not as high as we were going into that one. We were really, really darn high, near 11%. We're only at 4% right now. And here's the first quarter. So we are first trillion. We are about as high in the PPO as we are that we were there. So we're pretty. That's a pretty decent move with a lot of volume. We had a lot of volume over there at that peak. We had a lot of volume over here at that peak, above the average, and we had a lot of volume right now, again, well above the average at this $3 trillion mark. So I think that's what's. We have this. I've told you before. We have this bifurcated market between, a bullish S&P 500 and a bearish Russell 2000. I think this is the biggest reason why, because Apple is pushing up to a mark that once it hits that mark, then it will be pretty much done going up, like it was the last couple of times. It was done there. It was done there. And at the best, we went sideways for about 6 months on Apple, and it's obviously the biggest mover in the S&P. At worst, we had that fourth quarter 2018, which is our last normal market sentiment decline. I wouldn't count COVID as a normal one. So before that was the last normal market sentiment decline. So is that what we have coming up right now? Let's take a look at the sector moves here and how they performed here this week. Whoops. Yeah, we'll take a look at this one. Well, let's look at the comparison chart first. So let's go comparison down here, and let's just go to this week. You can see the risk on move. Again, look at XLK. That's your big mover. That's by far the biggest. In fact, that's the only one that outperformed the S&P. Energy was close and pretty much right on it, but that was the only one that had any kind of significant outperformance of the S&P as a whole. Was XLK. That drove all this price. Everything else lagged behind. Even XLY and XLC lagged behind, and they were all pretty much dragged up by XLK, and pretty much, didn't really move. After that Tuesday, like here's that Tuesday run where we gapped up and it didn't really go anywhere. And then after that Tuesday gap up, then here is from Wednesday, Thursday, Friday, and you can see Staples was up, healthcare was up, XLK was up because of Apple, but then you have financials down, energy down, communication services down, real estate down. So you have all sorts of cyclical in different areas of the economy all struggling after that. I guess we didn't really confirm that gap up on Tuesday with some good strong performance across all these kind of bullish cyclical sectors. Again, outside of XLK, which of course is driven largely by Apple. So here's your stocks that are in the XLK. You can see Taiwan Semiconductor, and there's Apple, Microsoft, Nvidia, and then you got Visa and MasterCard in there. Holding up, but pretty much it's been the Apple and Microsoft show that's really been driving XLK up to the upside. All All right, so for our trade idea, I wanted to take a look at Micron. Micron's been on a really good trend. It had a, it got dark green shading in the green line. It had an overbought cluster at the beginning of its intermediate rally. It's been kind of stagnant since. In fact, if you look at like, you had a really strong Hakinyashi candles here on Micron, closing above the previous week's highs, but then not the last two. In fact, last week we had a lower shadow, an upper and a lower shadow. Not only did it not close above the highs, but so really you can see the differentials falling. You got rising PPO, but it's just kind of consolidating right now, moderating. Obviously, when you look at the 3 green arrow chart, you can see the MACD histogram is rolled over. It's actually red right now. So when you look at what that means is you're in bullish convergence mode. When you look at the 2-line version of the MACD and stochastics, whoops, not MUSA, it's MU. Nope, not MUX, MU. There we go. You can see that the MACD is below its moving average. But you're still above the 17-day. You're in bullish convergence mode, and it's hard to kind of, you're back above the 200-day moving average. You're back above the point of control. So you're bullish. You're not bearish anymore. You're not in golden. You're not necessarily in golden cross stage yet, but you're also not in death cross anymore. Like you are in death cross, but the 30 days crossed above the 50. The 30 days about to cross above the 200. I mean, it's holding, right? Now it appears that it's kind of, you got this 200-day breakout that we're just going to consolidate to try to help that 50-day kind of catch up and give us that golden crossover and then get that escape velocity. But right now, when you're in convergence mode, it's kind of hard to get that escape velocity to really break out to the upside. This is what it looks like. And you do have earnings coming up, mind you, as well here, not next week, I believe, but the week after. You can see the ADX is really high. We've had the parabolic move. Now we're consolidating. When you look at the RSI and the CCI, you can see they were at strong levels, well up above 80. We're still in bullish territory, but obviously consolidating. Same thing with the CCI. When you look at the Ichimoku trend cloud, we had a very strong, whoops, why it does that? You had a very strong level. You still have a very strong level, but now you're kind of not so far up above that green line anymore. You're kind of flirting with getting below the green line and above it. And you're just kind of moderating, and that's kind of just normal moves. You're in the upper, you were trending. You were in the upper quartile. Now you're in the middle half, but at least you're in the upper, the second quartile. So at least you're still above the midpoint of the chart. You're just not in that upper quartile, which very typical of a moderating chart. So what I decided to do here was to sell a put spread, and I'm going to go a little bit further out than normal on the put spread, and I'll show you why here in a second. I'm going to sell the 72.5 and buy the 70. On the call set, I'm going to be a little bit aggressive too, and I'm going to sell the 92.5 and buy the 95. Here's why. We do have earnings coming up, and I'm not so much concerned about a breakout to the upside because that's just not the type of market we're in. And if it breaks out to the upside, of course, considering we've already had this and we're consolidating this really good bullish move right now, that's another reason why I'm not as concerned about a breakout to the upside. I'm more concerned about a breakout to the downside, coming back and retesting the 200, retesting maybe the 50, retesting that value area. So I wanted to give myself plenty of room to the downside. So you can see that's where my break evens are. Let me get rid of, you can see I was fiddling around with prices there. There's my break evens. When I put them onto the chart, they're right there. So my top break even, I have some room to go up to these old high points, the 52-week highs. So there's some upside that it can play with. But there's my risk going into January expiration, again with this earnings. But then there's my downside. So I essentially have taken away my downside risk as the 1 standard deviation move is there. But it's also the bottom of the value area. There's a lot of support in that spot down there. So very good area to put my break even on the downside. So that's why I moved so far down on the put spread and got a little short on the call spread so I can keep my credit about where I want it to be for this trade. Alright, well that does it for me. You've heard from me now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, subscribe to our YouTube channel as well as our website at marketscholars.com. Hit that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your weekend, everybody, and we'll see you all on Monday.